Hi and welcome to this week's edition of Team Wealth Builders. Wow, it's all happening. Yes, I'm going to talk about interest rates because we're at a 53-year low, or the first time it's ever been done by the Reserve Bank. But I also want to start with probably why it's all happening, and that is the number that just jumps out at me is the auction clearance rates in Sydney and Melbourne just in April and May. I mean, it's been going on all year, but it's been building. 78% in Sydney, 73, 74% in Melbourne. Now, these numbers were 50-something% a year ago, and on volumes, the volumes that are being pushed through are 50% higher. It's incredible. Nearly 3 billion in Sydney and 3.4 billion in Melbourne. So people were saying, oh, Melbourne's off the boil. Well, this year, they're up probably 25 or 30%, and Sydney's up 50% on volume, but more staggering is the actual auction clearance rates. And you saw just recently the two record sales in Sydney, 53 million and 33 million, both to Chinese buyers. And I've said all along, wait till this wave of Chinese starts buying here. It'll be a tsunami. Guys, it's happening now. Okay, let's talk about interest rates. A record low. Never seen in our lifetime before. Absolutely phenomenal. The banks passed it on straight away and almost signalled that there's room to pass on more. And the Reserve Bank said we might even ease more. And there's a lot of people saying that it'll come down even further. If it does, you're going to be in a position to lock in interest rates, potentially with a 3 in front of it. I mean, that's how staggering this is. 3.99, maybe 4%. But I would suggest you could potentially get a lock-in rate at 4.5 sometime towards the end of this year. Why are they reducing rates? One of the big issues was the Australian dollar that was flagged in the minutes of the Reserve Bank, is that they believe it's too high and it's affecting our agriculture, our farmers, and certainly affecting our manufacturing. And with the mining boom subsiding, there's now a need to prop up and growth in other industries. They want to prop up growth in property. They want property prices to grow. Now, if that's not a signal to us, because we buy for growth, to get in, solidify our portfolios, I don't know what is. You can buy a property now and be cash flow positive. I mean, I'm really actually excited about this. I've never seen it before as clear as this, with interest rates continuing to come down and rents rising. The hot market around the country is Sydney. And that is phenomenal because that's the market traditionally that leads Australia. What concerned me in the last cycle or the last boom where we had that rise through 9-10 was that it was led by Melbourne and sort of followed by Sydney. Both went up by 26%, Melbourne leading, but Sydney was slow to get started. Now Sydney is way in front and there's such a demand in Sydney. It's just phenomenal. We're seeing clients settle properties they've purchased off us in Sydney and the valuations are higher than their purchase price even at the times they've settled it. Phenomenal. Melbourne, exactly the same. The market is running there. There's a shortage of stock. That'll translate to Brisbane and now we're back to a traditional cycle. Melbourne, Sydney, or I should say Sydney, Melbourne and Brisbane. The other news was Melbourne, I should say Victoria, announced a $10,000 building grant, which is solid news. Why it's solid is it'll prop up new housing, and that really just gets added on to the value of housing in those areas. So we are in the start of the boom. And look at those auction clearance rates and look at the volumes, 50% and 30%, significant. We're at the start of a boom. You can now, it's actually cheaper to buy than to rent property in the major capital cities. In 30 years, I haven't seen that. And as I said, it's cheaper to buy than to rent. It's cheaper to buy than to rent. Let me say it again. It's cheaper to buy than to rent. Now, what's driving it all? And why is the Reserve Bank, reducing those rates? As I said, to reduce their dollar down, but there was a couple of things behind that. And that is the US is printing $85 billion a month and putting $85 billion a month into their market at 0.25%. The euro, which had interest rates fixed at 0.75%, just last week, or the first week of May, reduced their interest rates to 0.5%. So there's pressure to devalue all the dollars around the world, and that's putting pressure on our dollar. And as one of the previous governors said, our dollar's too high, way too high, and there's even talk that we should get our dollar right down, and the only way to do that is potentially bring rates down to 2%. That's another 0.75% cut, and that's what's forecast during 2013. Now, we're in record territory now, where you can buy, you can be cash flow positive. They want property prices to grow because they want growth. So let's heed the opportunity with this, because I think from a strategic planning perspective, you want to be building your portfolio now and putting yourself in a position where you can lock in that portfolio at these low rates when they actually reach a bottom sometime in 2014. And think about that from a strategic planning perspective. And I'll be holding strategic planning sessions with custodians in groups in different areas and different cities, and I've put this out to our state managers. So if you're interested, contact your state manager, tell them you want a strategic planning session, and let's look at how to actually set you up to take the most and make the most of this boom. It started. All you need to do is look at what's happening in Sydney, and it's so encouraging to have our biggest market now absolutely on fire. Enjoy the ride. Thanks for listening to me.